This is Chuck Carnevale. I'm the Chuck in the Market's Up, Chuck. And, you know, I've actually dedicated this week's blog to talking about the relationship between earnings and market price. And in today's, you know, paper, I'm sure a lot of you have seen it already, Warren Buffett has announced that he's purchasing Burlington Northern Santa Fe Railroad. He's paying about $34 billion for the 70-some% that he doesn't already own. But I thought what would be interesting, since the kind of theme here was looking at the relationship between earnings and market price, was look how Burlington Northern stock price has tracked earnings. As you can see here, there's a 20-year chart, and this green line with the white triangles represents the earnings per share of Burlington Northern. You can see that the black line, the stock price, has correlated to that very closely. There are times when the price got below earnings, and that was a precursor to some, you know, down years. But then when the company's earnings, you know, grew, the stock price followed it. The recession came along. You know, earnings obviously fell, so did the stock price more than the earnings. And, you know, the bottom line is Warren has actually made this move at a time when, you know, the company was actually trading at a discount to what would be normal value. If you look at it from a forecasting point of view, the consensus of leading analysts following Burlington Northern are looking at a 10% growth rate. At its normal price-earnings ratio, you know, that would value the company at about $105 a share, you know, based on our earnings-driven rationale. Warren's paying about $100 a share, so he's buying at a slight discount to intrinsic value. But because the price is depressed, you know, Warren's, you know, opportunity here was to buy the company and, you know, go all in, because, as he said in this thing, you know, it's really an all-in wager on the future of America. If you look at Burlington Northern's history, they have a nice dividend record. They haven't had a history of raising their dividend for the first part of this 20-year period, from 91 to all the way through 97. They held their dividend, but then since 1998, as their earnings growth got a little better, if you remember from the previous chart, they did go through a period where they, you know, had some dividend increases. One dividend decrease, as you can see, back in 2002, which is right coming out of the recession. But generally speaking, they'd have a good record of raising their dividends. In 2008, they, you know, had a nice dividend yield against the original investment. $100,000 investment has grown to over $800,000. That's 11.7% rate of return, and that correlates very closely to the 9.3% growth rate, you know, considering that the stock was somewhat undervalued at the beginning of this period. So, you know, Warren made a nice purchase here based on fundamentals, and the point of my blog was, you know, this blog is dedicated to the idea that, you know, successful investing requires optimism. I fervently believe that, but it does require optimism built on sound fundamentals. Warren Buffett's an optimist, but he's not being, you know, a wide-eyed optimist either. He's still buying a really terrific company at a terrific value. He's got a good dividend yield. It's a way to allocate money where he can, you know, look to get a 10 or 11% rate of return plus dividend, plus a possibly growing dividend. So, you know, Warren's obviously no fool, and Warren knows value. It's Chuck Carnevale saying, hope you enjoyed today's post, and thanks for listening. See you. Talk to you again tomorrow.